2018, $10.6 million. So total primary government, which is the city as a whole, you do have $83.3 million for total revenue. Netted out with all the expenses, governmental activities for the current fiscal year, $70 million. Last year, you do have $71.8 million. For business type activities, $9.3 million compared to $12.1 million. So totaling $79.3 million to $83.9 million. So during the current fiscal year, you do have a positive operations. I would call it this is a surplus for the current fiscal year. For the governmental activities, you do show a $1.7 million. For your business type activities, you show a $2.4 million. And then for the total primary government for $4.1 million. Bring it up from your beginning net position of $275 million to $279 million. So which is a pretty good operations for the current fiscal year. Councilmember Carla, I'm not quite sure which number that you are referring to regarding to the $200,000 differences in compared to the prior year number.
Under governmental activities for 2018, if you go down to the excess deficiency, it says 5.5. 2 weeks ago, it said 5.4. Last year, it said 5.3.
The reason because of this is a condensed financial statement. So basically, it is a rounding issues. So it's not really off by the numbers, but this is some of the rounding that we need to deal with when it's actually going to in millions dollars. So sometimes the 0.1, 0.2 is basically a kind of make the numbers tied out. So that's why it is not really off, but because of the rounding, so it may happen when it presents as a condensed financial statement while you don't see all the numbers.
So I understand what you're saying. The fact is, rounding rules do not change. So that doesn't sound good to me.
So starting on page 10, basically giving the city a more elaborations on the change in net position. So basically, I'm not going to read it line by line, but as you can tell, you can see the narrative on talking about the differences, why the net positions actually increased in the current fiscal year, and then break it down into the 3 different categories of the net position, which is the investment in capital asset, the restricted, and then the unrestricted. One of the things that is pointed out, as you can see in the graph, the net unrestricted deficit of $99.7 million. As you can tell, the deficit is actually caused by the implementation of GASB 68, which has happened 4 years ago, and then also GASB 75, which happened last year in 2018. So both, when you added the liability, that is more than your unrestricted number, and then also the net pension and net OPEB liabilities are basically long-term liabilities, and that create these deficits of for the city as a whole. The restricted, which is restricted by third party or enabling legislation of $64.2 million. And then also the net investment in capital asset, $273.8 million. So basically, majority of your net position is in your infrastructure asset there. And then also, bottom part of page 10, you can see when it gets down to the governmental activities, it breaks it down the explanation on the revenue side, and then also on the expense side. So page 10, 11, it talks about the governmental activities by revenue and then also by expenses. Page 12, talking about the different major funds, the couple major funds that the city have is the general fund, which is the main operating fund of the city, the major special revenue fund, which is the sewer and storm drain fund, that provides the wastewater fund and sanitation throughout the city. So it does actually require the city, because they are major, they are required to have separate disclosure and discussion in this MD&A. And then for your enterprise fund, water fund is your main operating fund in your enterprise fund. So it does actually talk about the increase in an explanation in on page 12. On page 12 and page 13, you do also show the capital asset that the city owns, and then also on page 13, it does show all the long-term liability, excluding the net pension liabilities and excluding the net OPEB liabilities. It does include the net pension liabilities for the city. So that is the total long-term debt administration for the city, and then also the last paragraph there's a paragraph talking about if you need additional information, especially for citizens, you can reach out to the city to obtain the information at their finance team. So going into the basic financial statement on page 15, there are a couple title page, and starting on page 18 and 19, which is the statement of net position, a point-in-time statement for the city as a whole, the balance sheet as of June 30, 2019. So the total asset for the city is $422 million, of which $313 million was classified as the capital asset, and $102 million are considered current assets that can be used by the city to pay current liabilities. On page 19, you do see the total liabilities, $160 million. So as you can see, the city do not have a whole lot of, do not really have any debt. The major liabilities that you do have it at the city, which is the pension liabilities and the OPEB liabilities, which equals to the pension for a total of $95.7 million, and then also the OPEB liabilities of $49 million, which is approximately $145 million in those two categories, and then the rest are claims liability and the compensated absences. So basically, the city do not have any bonded debt, which actually make it a much more, for financial health purposes, I think this is good that the city is not relying on debt, and then ended with a total net position of $279.6 million. So $313 million is is classified as investment in capital assets. $64 million are restricted, and then resulting the $97.7 million in total as unrestricted deficit. You can see that there are two other elements, the deferred outflow of resources and deferred inflow of resources, but because of the implementation of GASB 68 and 75, there are certain actuarial assumptions, the amortization part will not being utilized in the current fiscal year. Instead of running through the operating expense, GASB actually do allow that to defer into future period. So that's why you do see there are elements relating to pension and OPEB are included in those sections. So the deferred outflow resource, $21.2 million, and then also the deferred inflow of resource, $2.9 million. Those will be used in the future period and account for in the pension expense or OPEB expense. Page 20 and 21, which is the operating statement for the fiscal year end 2019 for the city. Also break it down by the functions and program. As a government, we're always looking at expenses first. So for total governmental activities, your total cost of running the city, which is close to $70 million. For business type activities, $9.2 million. However, the city may be able to recover from those what we call charges for service or by grant program. So total governmental activities, the total program revenue is about like $23.1 million. And then for the water service, you do have $11.4 million. So as a result, the net cost of service for the governmental activities, which is $46.8 million, compared to the water activities, you do have a net gain of $2.1 million. So one thing that we also look at is the total governmental activities, which will be subsidized by the general revenue, which includes tax revenue of $45.6 million, investment earnings of about like close to $2.4 million, miscellaneous revenue $357,000, and transfer from the water fund of $162,000. So total general revenue and transfer of $48.5 million. So that's why this year you do have a surplus of close to $1.7 million for the governmental activities, and then for the business type activities for $2.4 million. So that's actually increasing your net position from $275 million to $279 million. So between the governmental activities and the business type activities, you do have a $4.1 million increase. So that is the full accrual basis accounting, so that you have a full picture. And then getting into the fund statement. The fund statement actually was started off with the governmental fund financial statement. So that's you can go to page 29. We started off with the governmental fund balance sheet. Keep that in mind. The governmental fund is using the current financial resource measurement focus and modified accrual basis accounting. So basically, the balance sheet is only reflecting the current asset and the current liability on these financial statements. So basically, you do actually meet based on all the information that we have and calculate under the major fund criteria. The general fund and the sewer and storm drain funds are considered major, and the rest of your other other special revenue fund and capital projects fund are grouped into the non-major governmental column. So basically, you do have like 3 opinions unit on this fund. So like looking at the general fund, you do have a total asset of $26.9 million. Net of the liability, $4.6 million. Total fund balance of $22.2 million. As you can tell, the fund balance are basically break it down into 5 different categories: the non-spendable, the restricted, committed fund balance, assigned, and unassigned fund balance. So the more detail is in the notes to the financial statement. So let me go to refer to note 11 on page 86. If you can flip to page 86, the fund balance. The general fund, you do have like 2 areas that we consider non-spendable: inventory of $300 and the prepaid of $7,306. You do have public access channel, which is a restricted dollar, $1.1 million, and then also the Measure U of $11.6 million. The committed fund balance, which is the economic stabilization reserve of $8.2 million. the assigned fund balance, you do have 133,000 for continuous appropriation, and leaving the unassigned fund balance of 1,085,000. So basically, you do have total of $22 million for the general fund fund balance. So this is more of the detail that you can get. And then going into the going back to page 29, basically this is your street, sewer and storm drain funds, and you do have $13.6 million for the sewer and storm drain fund, netted in the total liability, which is considered current, $2.2 million, resulting a $11.5 million. Because this is a special revenue fund, and also this is a Prop 218 fund, all the monies are actually restricted in this fund. So basically, therefore, you don't see any unassigned fund balance for the sewer and the storm drain fund, and everything considered restricted. And then the remaining of the fund is the non-major governmental fund, which is the funds that have not meet the criteria to become major. So total of $47 million, net of total liability $3.2 million, and then the total fund balance, which is $43.8 million. So therefore, the total governmental fund activities, you do have $77.5 million for total fund balance at the end of June 30, 2019. And keep that in mind, this is a modified accrual basis. On page 30, you can see the reconciliation of the fund balance to the total net position to the government-wide financial statement. And as I said, because the fund financial statement are using modified accrual basis and current financial resource, so that's why all the long-term asset, long-term liability are not reflected in those financial statements. So that's why GASB also requires to do a reconciliation on the total fund balance from the governmental fund to the net position shown on the government-wide financial statement. So see how you come to from $77 million to $273 million, and including the capital asset of $308 million, netted the compensated absences liability of $2.9 million, the pension-related pension liabilities and the related deferrals, inflows and deferred outflows, $70.4 million, and then also OPEB liabilities and the related deferred inflows and outflows of $32.7 million. And then also we need to blend it in the internal service fund of $5.7 million back. So that's why at the end of June 30, 2019, the total governmental activities net position of $273 million. On page 31, as you can see, this is your income statement for the governmental fund. I'm going through the general fund, total revenue $53.9 million, of which the major revenue is your tax revenue, which is $45.5 million, and that's also include the Measure U money. Total expenses $47 million. So the revenue over the expenditure by $6.5 million. So you do need to subsidize other programs, so there are transfer out of $1.1 million, and also netted the transfer in from the enterprise fund. So the total other financing sources and uses, which is a $964,000 outflow. So at the end of the day, June 30, 2019 fiscal year, you do have an increase in your fund balance of $5.5 million, bring it up from $16.7 million to $22.2 million. For the sewer fund, you do have a total revenue of $4.3 million, net the total expenditure of $2.1 million, so the operating increase of $2.1 million, and there's a transfer out to the internal service fund to pay for some of the cost, which is $37,000. So the net change is $2.1 million. So bringing up the fund balance from $9.3 million to $11.4 million. So the non-major fund, $13.4 million of total revenue, net of the total expenditure, $11.4. So total approximately a $2 million increase in your operations. Net the transfer of $79,000 outflow. So at the end of the day, the increase in fund balance by $1.9 million. So everything going up by from $41 million to 41.8 going up to $43.8 million. Okay, so total governmental activities, $71.5 million in total revenue, $60.9 million in the total expenditure. Netted out the total financing sources, $1,081,000. So the total net change in fund balance is close to $5.6 million, bringing it up from 67.9 to 77.5. And then same thing that we need to do a reconciliation and change it from modified accrual basis to full accrual basis. And so basically you can see the $9.5 million and then going down to the change in net position for the governmental activities of $1.6 million. And you can see all the differences here in this statement. So going to page 35, walking into the proprietary funds. The proprietary funds, you do have like two different fund. One is the enterprise fund, and the other one is the internal service fund. So the internal service fund is the aggregate information of all the internal service fund and consolidated into one column and presented here. So for the water fund, as of June 30, 2019, you do have a total asset of $18.8 million, total deferred outflows of resource, $1 million, total liability, $13.8 million, total inflow of resources, $272,000, resulting in a net position of about like $5.7 million, of which $3.9 million is considered investment in capital assets. Those are your infrastructure assets, and it's not liquid, so that's why you have a separate category, and then resulting in unrestricted net position of close to $1.9 million. And for the internal service fund, total asset $9.8 million, close to 9.9. Deferred outflow of resources, $1.2 million. Total liabilities, $16.7 million. Deferred inflow of resources, $250,000, and a net position of $5.8 million deficit. And investing in capital assets close to about like $1 million, and then the unrestricted was about like $6.8 million. So the total income statement, going to page 38. Total revenue for the water fund is about like $11.5 million. So the operating cost, including depreciation, so $9.2 million. So it's resulting a operating income of $2.2 million. You do actually recognize investment earnings, close to $350,000. Also having the transfer out to the general fund of $162,000. So the net change in net position of $2.4 million surplus for your water fund. So bring it up from $3.3 to $5.7 million. For internal service fund, because this is a cost allocation fund, so the total operating revenue basically is the amount of money that you charge to different departments, $14.5 million. The total operating expense, $17.7 million. So resulting a operating income of deficit of $3.2 million. So you do have another transfer in to subsidize some of the costs, $1.2 million. So the change in net position, which is equal to $1.9 million. So bring it the net position deficit from $3.8 million going up to $5.8. In order for you to take a closer look at it, because these are full accrual basis, so in terms of a shorter term, you need to see the statement of cash flow. So basically, we use a direct method in calculating the statement of cash flow, and you do have 4 different categories. You do have the cash flows from operating activities, which is the major categories that I will focus, especially on the water fund. The cash flows from capital activities, cash flows from non-capital financing activities, and then cash flows from investing activities. For the cash flows from operating activities, basically you can see $11.5 million coming from the customer, paying the suppliers of about like $5.6 million, paying the employees and related services, $2.8 million, and then cash payments for insurance, $111,000. So the total cash provided by the operating activities, $2.8 million. These numbers are very, very close. You should be expecting these are very close to your income statement. And then also for the current fiscal year, the city expend about like $372,000 on your capital asset. The city do paid out to the general fund about $162,000. And then also there are interest received of $350,000. So the net change in cash position, $2.7 million increase, bring it up from $10.5 million to $13.2 million. Looking at internal service fund, the net cash used in operating activities, $2 million and $30,000. So at the end of the day, the cash and cash equivalents coming from $8 million to $7.3 million. Going into the fiduciary activities, you do have like two other funds. One is the private purpose trust fund, which is accounted for the former redevelopment agency, and also the other agency fund that you have. So the successor agency, which is a private purpose trust fund, total asset $2.9 million, netted out all the liabilities and $659,000. No, I'm sorry, it's $9.7 million. So resulting the net position deficit for the successor agency of $6.7 million. And then also the agency fund, you do have like $2.3 million in total asset and $2.3 million in total liability. Agency fund is as custodial purposes, so that's why you don't see an operating statement. However, because the
I think we lost you, Kenneth. Kenneth, are you there? He was on a cell phone. His battery might have died.
See if anybody's trying to call in. He's on there. I don't know if they'll have or something. Maybe we can take a brief recess in here.
Why don't we take a 5-minute technical recess?
Ken, if you can hear us, we can't hear you.
And if you're still with us, I want to let you know we can't hear you.
Okay, he's calling in again.
Mayor, this is Lorena. Can you hear me?
I can hear you fine.
Can you hear
Okay,
me? This
I
is Ken.
just got a hold of Ken. He's trying to call back in. His call must have dropped.
Are you able to hear me now?
We can hear you now. I think we lost you somewhere around page 45.
Page 45. Okay, I can go back.
You mean you went on without us? Okay, we took
I'm sorry, because
we took a brief
no signal here.
technical.
I'm trying to. Yeah, no problem. I can go through page 45.
Okay, we took a brief technical
page
recess.
45.
Okay, we're back in session.
Okay. So the city do actually have two fiduciary funds, basically including the successor agency, which is accounted for all the redevelopment, like the former redevelopment agency activities, and then also the agency fund, which is the custodial fund. So for the agency fund, because of the custodial purposes, so that's why you only show the asset and liability on the face of financial statement and you don't see an income statement. However, you do see the successor agency and ended with a net position deficit of $6.8 million. And then going to page 68, this is, as you can see, the total addition to the fund and then the deduction to the fund. For the successor agency is mainly coming from the RPPTF fund, close to $1.2 million, reducing by the administrative costs and the interest costs, $577,000. So bring it the net position up by $577,000. So as you can see, your deficit has been dropping from $7.3 million to $6.8 million. Starting on page 49, which is starting the footnote disclosure. So, note one, instead of having me going through, I'm going to pick a couple of the major note disclosure that is more sensitive to you. So one is actually the talking about the reporting entity. So the reporting entity not only talking about the city, but also including the activities of the Hammett Housing Authority, which is a blended components unit. And for financial reporting purposes, those activities are blended into the financial statement and consolidated within your governmental activities. Starting on notes 2, the summary of significant accounting policy. Basically, this is a summary of like everything that is adopted by the city. So it actually started out with the basis of presentation, talking about the basis of accounting, the measurement focus that is being used by those different types of funds. So as you can see, the next couple page on page 52, 53, and 54, because of the different fund types, so basically detail listed out on the measurement focus, the basis of accounting, and the financial statement presentation. So note 2 also include the way that the city is accounted for cash, the investment earnings, the fair value measurement, how you account for receivable, inventory, in-the-fund transactions, forgivable notes, land held for resale, capital asset, due to other governments, condensate absences, claims and judgment, long-term debt. I would like to point it out the pension and OPEB, because consider when we prepare the financial report for GASB 68 and GASB 75, GASB allowed the city to use what we call the measurement date instead of the financial reporting date. So for pension purposes, the city is using a valuation date as of June 30, 2017, and the measurement date of June 30, 2018. As you can see, the valuation was actually lapsed for 2 years, and then the measurement date was actually lapsed by 1 year. And then also the OPEB plan, and actually the city is using the same reporting date as using the measurement date as the same as the financial reporting date, which is June 30, 2019. So there is no lapse in the for the OPEB plan. And you do also see the deferred inflows and outflows, net position, the spending authority based on the different types of fund balance. So you on page 60 actually detail listing it out, and then also on page 61 you also see your spending policy if monies are available in different class of fund balance. Okay. You do show the property tax calendar, and then the use of estimate, and then also in notes 2, it talks about the implementation of the 2 new GASB pronouncements. So those are the summary of change, the summary of significant accounting policy that is adopted and tailor-made for the city, not from another city. Note 3 is talking about the cash and investment portfolio. So as of June 30, 2019, the city do have a total of $92.4 million between the cash and investment, and then investment with physical agent. And also keep that in mind, this also includes the money that is kept in the fiduciary funds. Okay? So kind of give you a lot of detail talking about the risk disclosure on page 65, different types of risk, interest rate risk, credit risk, and then also on page 66, the concentration risk and custodial risk. Page 67, the in-the-fund transactions, we are required to talk all about all the in-the-fund transactions, including the due to, due from, and transfer in and transfer out. Page 69, capital asset, note 6. So you do see the roll forward schedule, how it rolls forward from 2018 to 2019 numbers. So as of June 30, 2019, total governmental asset, you do have about like $309 million in your total capital asset. On page 70, you do on the top you do see the depreciation. Depreciation is one of the estimates that is being used in these financial statements. And because of the governmental activities are not reflected in the fund statement, so that's why you can see the $7.3 million is only reflected in the government-wide financial statement, except for the internal service fund, the $146,000. The business type activities, you do have about like close to $3.9 million, and also you do see the total depreciation for the water fund is $654,000. Page 7, listing out all the long-term debt that the city owe, and as we talk about, the city does not have any bonded debt. So basically, within your long-term liability, you see the compensated absences, claims payable, and then the two major liabilities, which is the pension and OPEB liability, which you do have a separate note disclosure talking about it. The only bonded debt that you have is relating to your successor agency, the 2014 tax allocation bond, which is disclosed on page 72. The city do have one non-city obligated debt, which is the CFD 1999-1, the special tax refunding bond, series 2006 on Heartland project. So it does actually require additional disclosure on this. Page 8 is talking about risk management and your self-insurance program, and you see a nice table talking about the limit and the how much that you are insured and how much you are actually self-insured on those. So on page 74, you can see a roll forward table showing the claims actually incurred during the current fiscal year, and then how much that the city is actually paying for those claims. So at the end of the day, the city actually did pay for, the city actually incurred about like $10 million for the current fiscal year in the different types of liabilities, and then also paid out the claims of $9.2 million. So that's why your total liabilities from $1.3 million going up to $2.3 million. And starting on page 9, you can see this is the city employees retirement plan. The city is a participation of the CalPERS plans on both miscellaneous and safety. So on page 75, it talks about, it gives you a summary of the liabilities and the deferred inflows and deferred outflows reported on the face of the financial statement, and then followed by the description of the plan. So one of the things that I would like to point it out, it's going to page 80, note 9, note 9C, change in net pension liabilities. And keep that in mind, this is an estimate that is reported. So basically, because of this is an estimate, GASB actually require us to use a sensitivity method, even though the city is reporting the current discount rate on the face of the financial statement. So, but it does actually require us to disclose whether the discount rate dropped by 1% and what is the impact to your liabilities, and then also what if the discount rate go up by 1%, how much is that going to impact your liabilities. So for miscellaneous plan, we are booking, the city is booking $34 million as your current liabilities, which is on the face of the financial statement. If the discount rate dropped by 1%, the liabilities goes up to $50.3 million, and vice versa. If the discount rate increased by 1%, the liability can drop it down to $20.5 million. For the safety plan, the city currently reported $62 million on the face of the financial statement, but if the discount rate dropped by 1%, the liabilities can goes up to $87 million, and then the discount rate, what if the discount rate goes up by 1%, then your liabilities drop it to $41 million, okay? And note 10, talking about the other post-employment benefit, this is the medical retirees insurance. So similar to the pension, this is purely an estimate and also determining based on the investment earnings, discount rate being used by the actuary. So going on page 84, you can see that the city actually do reflect the liability using the discount rate of 6.25% of $49 million. If the discount rate dropped by 1%, the liabilities can go up to $54 million, and if the discount rate goes up by 1%, the liabilities can drop it down to $44.3 million. The city actually do have a net asset in your Section 115 trust. So as of June 30, 2019, the balance was $1.1 $1.3 million. Other important disclosure, Note 11, basically we already walked you through the different types of restriction regarding the use of the fund balance. So on page 86, so that's why I'm not planning on going through in detail again. As you recall, Note 13, individual fund disclosure, basically talking about the funds that had a deficit to it and require additional disclosure. And then also Note 15, the subsequent event, as you're aware, we are all impacted by the COVID-19 since March. And one of the things that we don't know, the impact to the cities as of this point. So basically, we do have a subsequent event note disclosure talking about the subsequent event. Starting on page 91, basically is one of the required supplementary disclosure as required by GASB Statement number 34. It does actually talk about the budget comparison schedule on the general fund. So as you can tell, this is pretty much the actual amount compared to your final budget amount. So the overall, the city actually do comply with your budget, except for general government, you do have an overspending of $30,000. But overall, the total expenditure, the city actually is under budget, so it's under by $3.8 million. So compared to the total revenue, the city actually do budget a little lower than the actual by $2.1 million. So it is completely favorable to the city for the current year operation. So for the operating revenue and operating expenditure, it is under budget by basically it's in favor of the city by close to $6 million. Netted out the other financing sources and uses. So at the end of the day, it is in favorable to the budget by $4.4 million. And then also for the storm drain fund, you basically do basically in favorable of the budget by $4.1 million. So it does talk about your budgetary accounting policy and procedures on page 93. And then also 94 and 95 are very, very important because I will look at these as a trend analysis because GASB Statement number 68 implemented about like 5 years ago. So we do have the 5-year trend on your miscellaneous plan and your safety plan. So under your miscellaneous plan, currently the city is actually 72.06% funded. Compared to your safety plan, you are 64.9% funded. And then also you can see on page 96 and 97, so these are your contribution to the plan itself. So for the miscellaneous plan, page 96, on an annual basis, you are contributing about like close to $3.8 million. As you can tell, the amount has been going up from 2014. And basically, it's still catching up from the last recession. So as you can see, your funding basis is going up for the miscellaneous plan, and same thing for the safety plan. The safety plan 5 years ago, like 6 years ago, you do have about like you are contributing $3.8 million, and up to 2019, your total contribution is $6.6 million, so which is a big chunk of money that you need to budget for. Page 98 and 99, and which is the OPEB plan. So the OPEB plan, you just started to fund it. So basically, the funding ratio is about like 2.64%. But at least you are starting to fund the OPEB plan, which allows the city to use a higher discount rate. And for the current fiscal year, the city actually do contribute about $4 million to $4.1 million to the plan itself, and then the required annually actuarial determined contribution, which is $3.7 million. That actually creates a additional funding for your to set aside for OPEB purposes. And starting on page 103 all the way down to 170, those are the individual fund information, and I'm not going into the detail. And then starting on page 171 to 213, those are the statistical sections. So that's basically covered my presentation for today. And if you do have any questions, I'm more than happy to answer as of this point.
Okay, Kenneth, thank you for the walkthrough of a very detailed report. And with that, I'll refer to council for questions. Michael? Linda? Carla?
On page 11, there's a graph that shows our sales tax. So is our sales tax that the city receives twice that of Measure U?
That is include Measure U.
There's a different pie for there. I mean, there's a different slice for Measure U.
Can you repeat your questions again?
On page 11 of the report.
Or the pie charts?
The pie chart actually do have a sales tax its own, and then also the Measure U sales tax. So basically 16% of the total revenue came from Measure U.
So my question to you is, isn't sales tax that we receive 1% also? And then the Measure U is 1%. And it reflects that we have 37 and 16, so it's showing that we get twice as much sales tax than we do Measure U, and they should be about the same, or the same.
Lauren, are you there?
Yes, I'm here. Without looking at the numbers, just looking at the graph, I couldn't tell you. Sales tax, the Bradley Burn sales tax is, the Bradley Burn sales tax is 1% roughly. The Measure U sales tax is actually transactions tax, so it's not, while it is 1%, it's not taxed the same way, so the amounts aren't equal. What also goes into the sales tax category is the half-cent sales tax for Prop 172 to fund public safety.
So maybe we can get some follow-up on that.
I'm sorry, Councilmember. So what we could do is provide a breakdown, because one of the interesting things about the CAFR is it lumps in multiple different categories of the various taxes. And so what we can do is break that out so that you have a better idea of what makes up that 37%, so that you get an idea of what those dollar amounts are.
Because there's another pie slice that says 4%. So
we can break
that's our
that.
property tax.
We can provide a breakdown of those dollar amounts so that you can see what that 37% is actually made up of in terms of the dollar amount associated with that. We can certainly do that.
Okay, and then on the bottom chart, it's probably more for you, Chris, but on the bottom chart, we always talk about public safety being 78% of our budget. This says 58%, so I just need you to explain that so everybody understands, so we know that.
Councilmember, that's a great question. Really what you look at when we talk about the budget, we've got two different scenarios here. One is the budget that gets presented to the mayor and the city council with the planned expenditures of the upcoming fiscal year. The CAFR is actually kind of the recap of what we were able to accomplish given the budget that we had. So I think what you've hit on is a little bit of a capacity issue with respect to when we have vacancies primarily in the public safety operations. what is our ability to actually bring those individuals on board given the natural attrition that happens throughout any given year. So when we budget, we provide for the dollar amount that's completely burdened, assuming that they are on board starting day 1, July 1 of any fiscal year. If at any given time you have individuals that leave the agency, whether due to retirement or you have vacancies in those positions, that's when you see the decline in actual expenditures that gets illustrated in the CAFR.
So to simplify that, you're saying that we budget 78%, we don't necessarily spend it all, and this is a result of what we spent.
You're absolutely correct. And so when we talk about the fund balance of Measure U growing and growing, that's what we have because we can't move forward on those expenditures. So that fund balance just continues to grow and grow and grow year after year because we can't move forward on those expenditures within those operations.
Chris, if I may interject here, this graph is not just general fund, it's governmental activities. So when you're looking at the expenses by function and public safety is down to 58, it's also because you're taking into account other functions of the city that are governmental functions. So that would be our public safety CFD costs, our sewer and storm drain is in there. So like sewer and storm drain will fall under public works. We have other categories in there. We have all of our grant funding involved in that. It's not just general fund. So this pie isn't going to look like what a general fund only pie would look like.
We need to make sure that we figure out how to be transparent so that the public understands. Maybe there needs to be a general fund pie chart so that it looks like we're doing what we say we're doing, if that's the case.
I think
we can definitely add that.
I think, Councilmember, what you also bring up is the fact that Measure U fund balance, we need to have a conversation, and it's one of the continuing or the future agenda items. Given that we're a few years into Measure U now, we need to have a realistic conversation about what the city expected in terms of Measure U back a couple of years ago or a few years ago back in 2016, what we were actually able to accomplish and what we can do moving forward because earlier today, and we have copies at the dais too, I provided an overview of the fund balance of Measure U as well as the fund balance of general fund. And you can see that the fund balance of Measure U continues to grow and grow and grow. And that's really the conversation that revolves around what we should reasonably expect in the upcoming years and how we can allocate that dollar amount to provide the improvements to the community.
Right, growing and taking away services all in the same year?
So this is the CAFR for fiscal year 18-19. As we delve down the CAFR for the fiscal year 19-20, you'll recall that we utilized a significant number of fund balance to make some capital purchases, but also to allocate some more funding for overtime. And so when we talk about what the year end looks like in just a few weeks, we're hoping to have something to the council by September. That's when you'll get a better idea of where we ended the year out. But we had planned already to chip into that $11.7 million fund balance